The maybe something to pose to Brendan and or Darryl. So I haven't got money offshore. I've got a material investment in SA. Do I take money offshore now? And I think that simplest question is one that we have to answer almost on a daily basis. Do we wait or do we go? And what are the guiding principles? I think we've been through some of those, but Darryl, maybe you want to start with exactly how.
Yeah, okay. So the answer in short, Pete, is yes, you do start. You get a start as soon as possible, because for no other reason, the opportunity set in the offshore markets once you leave the South African shores is immense. However, it's easier said than done, and buying hard currency or making that initial step is an emotive thing for us South Africans, really. I don't want to pay 1 cent more for a dollar if I can avoid it, which often means that I'm waiting in this kind of, stuck in limbo trying to time the currency. I can assure you that in 5 years' time, you will not remember whether you paid 14 Rand 50 or 13 Rand 50 for your first dollar. But I can also assure you that the diversification that you would have given yourself by taking that first step in making an offshore investment would have been the right decision.
Okay, what's the most cost-effective way to take funds to the offshore account? What would you say is the minimum amount in SA rands that one should have to initiate this kind of investing?
Okay, so I'll take that one. There is no minimum, is the straight answer. However, there are some key considerations. One of those considerations is there's a relatively small 750 Rand fixed cost that's charged by the South African Reserve Bank to actually make exchanges into dollars. So just working off that figure, because everything else is a variable cost, naturally speaking, it does make sense to bulk up amounts of let's say 100,000 Rand or more when buying currency. A bigger consideration for me, though, is what am I doing with that money when I get overseas? The reality today is that it's going to cost you the equivalent of 50,000 Rand to buy one Amazon share when you get into the offshore markets. And so for smaller amounts of money, how do I create a level of diversification in what I'm investing in dollars? And so certain investments make sense for certain amounts of money, but working alongside your financial advisor to determine what that means is a key consideration. Long story short, there are products out there that cater for $1,000 investor, and there are products out there that cater for $1 million investor. It's time to get a start now, though, if you haven't.
Your opinion on a European joint account as a structure to hold your offshore assets?
So yes, you can do that. I think we just need to be a bit specific about which European country are we talking about, and to understand whether that joint account, because very often why one has a joint account is if one of you dies, the account can continue, and that's always quite specific to the particular jurisdiction. So that's the answer. Yes, you can. I think you've also just got to be a bit careful that whatever jurisdiction it is, that you get the estate duty rollover relief on death that applies between spouses. If I need to explain any more on that, please let me know, and I will. Those are the basic rules.
I think a lot of this stuff is quite technical, and a lot of the answers to many of the questions depends on your own specific situation. But we'll certainly try to give some blanket answers where applicable. So how does the tax residence liability to pay tax on international assets impact on the tax havens? Do you understand that question? Do you want to give
Just repeat it, please.
How does the tax residence liability to pay tax on international assets impact on the taxless havens?
Taxless havens.
It's actually misspelled. So interpret that as you wish, Dar.
Thanks. So when you're talking about taxless havens, you're basically talking about those little circles that I mentioned. And the reason why you're there, and it depends which one you're in. Mauritius has certain taxes that apply. The Channel Islands don't have any taxes that apply. So what's more important is where you are tax resident and how it impacts whatever you're doing, how it impacts your tax residency. Those taxless jurisdictions are taxless. So I don't know if that helps you or not. Again, it's very case specific. as to where.
Thanks. A question from an old friend of ours, Mark Meehan. If one has arranged Portuguese tax domicile based on the lease of Portuguese property, but one has no Portuguese assets, is a Portuguese will required to deal with those worldwide assets or only Portuguese assets? Again, that's quite specific, but Dave, I don't know if you've got any.
Yeah, so we might have to come back on that. But basically, if you're tax domiciled in a country, one would assume that then the laws of that country would apply on your death, or the taxes in that country would apply on your death.
Thanks.
So if
Brendan, the question.
Asking.
I'm just going to state there that I think wherever there's fixed property and you in a particular sort of country other than, when you're using investments and you're using wrappers or structures and there's beneficiary nominations, things are a bit different. But where you have fixed property, I would certainly say that 90% probability that you are going to need a proper will in that jurisdiction to be dealt with correctly. Okay, so
I think what Mike was saying there was that there's no property, it's just rental property. Is that right? Is that what the question said?
Yeah, so I think perhaps apply both. Yeah.
I think we can come back to you on that. It's a tricky jurisdiction because there is forced heirship in Portugal.
Yeah.
Brendan, one for you. Could you discuss other mechanisms to avoid citus tax? For example, keeping investments below thresholds, owning exempt assets, or via correct jurisdictions?
Yeah. So, I think the structures, for example, citus taxes themselves, or if you've got a correctly domiciled unit trust portfolio, that could easily, that'll be exempt from the citus tax. The US, they've got a threshold, I think, of 60,000 for the, I think it's a 60,000 US dollars before citus tax would kick in, and I think the UK is 320,000 pounds, 25,000 pounds, or somewhere in that. So there are various sort of rules around it. But if citus tax largely applies, to sort of certain assets, be it, properties, individual, holding properties, physical properties, as well as the shares, which are domiciled in certain areas. So, those are the assets they look out for. Using structures and things like that are easy and very effective at getting rid of the citus problem.
Darryl, an easy one for you. If you invest in a local ETF or mutual fund, how is that viewed from a foreign investment perspective? And how do we view that versus taking the actual money offshore?
All right, so I assume you're referring to a local ETF or mutual fund that references an offshore portfolio, Pete? All right, so
the question, both.
Yeah, so
obviously to get offshore exposure, yeah.
Yeah, okay. So first prize, in our opinion, is get your money overseas. As individuals, get your money overseas via a single discretionary or foreign investment allowance. Asset swap being third prize, because when we're investing overseas, we want to know that our money has left the shores forever. Now, when you invest locally in an offshore fund, naturally that is done by an asset swap, or it's treated in the same way as done by an asset swap. So you have a local fund that remains a South African asset in the eyes of the South African Revenue Service and in the eyes of the South African Reserve Bank. And as I mentioned a little bit earlier, there are certain tax benefits to actually having money overseas in the calculation of capital gains. So first prize, get money overseas. But second prize, you get exactly the same exposure in rands by investing via a local ETF or mutual fund.
Okay, interesting one. What are the tax implications if you've got a joint offshore equity account in the US with your spouse, externalized and not in a wrapper, and one of you passes away? Does 50% of the portfolio go into the deceased estate? Again, all these questions are quite specific, but
yes, the answers. So the answer there is yes, and you don't get the rollover relief in your will in South Africa. If you leave your assets to your surviving spouse on death, you also take over their 3.5 million rand estate duty exemption. But if you have a joint account in the US, that rollover relief does not apply, and half of the assets will go into the deceased estate.
Okay, then the CGT implications of asset swaps. Could you perhaps give an example, Darryl? And I think the important part really there is...
I'm happy to give that example.
Yeah.
So, in the normal course of events, let's use 1.5 million rand that I want to buy $100,000 with, assuming the exchange rate is 15. If I take out my 1.5 million rand via foreign investment allowance and I buy $100,000, the calculated capital gain at the end of any tax year is effectively, let's say that the portfolio grows by 10%. My capital gain and the rand appreciates by 20% in the year. My capital gain responsibility, if I've taken it out directly and not via asset swap, is based on the $10,000 growth only. However, if I've taken it out via asset swap, the full capital invested is exposed to currency depreciation from a capital gains tax calculation. So, in other words, not just the $10,000 you've made, the capital depreciation on the 20% on the initial capital as well. I'm making it sound a lot more complicated than it is, but long story short, asset swap, you are fully exposed to currency depreciation against your original capital versus foreign investment allowance only on the dollar gain that you make.
If you made a 10% return in dollars, if you're taking it out, you're paying tax on CGT on 10%. If the rands depreciates about another 5%, you're paying tax on 15%.
Spot on.
That is what we're looking
More
at.
simple.
Darryl, maybe a wrapper question. Can more than a single owner own a wrapper? And would the wrapper continue for multiple owners? So if one of the multiple owners dies, how does that work?
It does. So we've had up to 4 owners, and there may be the ability to have more. So the answer to that question in short is yes. The wrapper lives. And even one of the additional benefits of the wrapper is you're able to nominate beneficiaries below the first layer of your contract holders. So in that example, say you've got husband and wife as your contract holders, something happens and they both pass away at the same time, the wrapper continues and passes into the hands of the nominated beneficiaries. So importantly here, you still pay South African estate duty on the value of your wrapper, but it doesn't get wound up in your estate. It passes seamlessly onto your beneficiaries the very next day, which is also why you save on the executive fees.
There's quite a few CITES questions here. CITES is a tax that we haven't seen applied, but we've certainly got some very strong messages from around the world that it will be. I think the more rigorous the jurisdiction, the more likely you are to face it. Holdings in the US are probably the most sensitive. We're going to see the examples from it. So a lot of good reasons. There's absolutely no point in taking that risk if you don't have to. But the 2 questions from a CITES point of view: which jurisdictions are CITES friendly for SA persons, and are UCITS ETFs exempt from CITES? So are ETFs viewed differently to shares? Dar, maybe you want to pick those up.
So I think it would depend where the ETF is registered is the most important thing to consider there. Darryl, you're nodding your head.
No, that's right, Dar. Spot on.
Okay, so that answers the one. And the next one?
And then what jurisdictions are CITES friendly, if that's a term that can be used for South African persons?
So they're lots. The answer is that they're lost, but the reality is it's where the asset is domiciled. So as an example, if you're buying Facebook shares, regardless of where your portfolio is anywhere around the world, CITES friendly or not, the original domicile of those Facebook shares is still the US. And so you may find friendly jurisdictions, but then you would also have to buy assets in those jurisdictions in order to benefit or to avoid CITES.
I think the other thing there is if you would need to look at structures as well, because there are jurisdictions that are CITES friendly because you got a structure held in that jurisdiction. It's not in your own name.
I've been told that cash in a US broker account is also subject to CITES tax. Is it different for money in the bank? And is that true? Do we have clarity on that? I think a lot of these things we don't have absolute clarity.
Yeah, I think we'd have to come back to you on that.
Cash amounts of money in the bank is not a citus asset though. So that's, and that's what Di's alluding to, is that it is a bit of a gray area, is that if that money was in the bank, it should fall outside of citus.
Then, Di, in terms of all these fancy structures, what amount of money makes it worthwhile to transfer offshore in order to justify the cost of, say, a trust structure? Let's just give some basic materiality on,
Okay, so that's quite a difficult question, because it also would depend on whether there's a line of further funds coming into the structure. But basically, your offshore trusts, your fees per annum are anything between $5,000 to $10,000 a year. So it's whether that's justified. So we look at any amount of funds from $1 million to $2 million. But certainly nothing below 1 million. And even that, one hopes that there's a further line of funds coming into the offshore trust. But those costs we can certainly go through with you. We've worked with them extensively for years. We do understand how they work.
So again, lots of individual and quite specific questions here. Maybe to just go through a few. If one's investment is in an offshore wrapper, surely on death, SARS will calculate the value of your investment using the exchange rate at the time of death. So, Darryl, I guess it would depend on how the money got there.
I don't disagree with that, absolutely. I think that when the calculation of your local estate, yes, that would be correct. Now, remember, of course, that the assumption, as is the case with any endowment wrapper, is that the wrapper provider is paying tax along the way for realizable events inside of the wrapper. But as part of your estate duty calculation, absolutely, you have a rand asset based on an exchange rate when you die.
But they will always look at what, they'll do the conversion to what the dollar value was when you took it out. Okay, it'll only be the capital gain in the dollar value, not the rand value, not the exchange. They'll treat it as an offshore asset rather than asset swap.
Yeah.
The kind of general question from an anonymous attendee, whether you have a specific knowledge and expertise to advise on structure if somebody's contemplating a possible US immigration. So, how would we deal with somebody who...
So if you're going to the US, again, I'm sorry, I keep on banging on about it. It's very important to understand your specific circumstances. But yes, we do have expertise, but very often it's so complicated. We do refer it to people that we work with who are experts on the US. And we have in the past used a US tax attorney to give us advice on recommendation from one of the top legal firms here, because the knowledge that one needs is so specific. It also depends here, are the assets in your own name? Are they in trust? Do you have offshore trusts? All of that comes into it. When you move to the US, it's very complicated. If you're just going in your own name and there aren't too many assets here, I don't think it's really too much of a problem. The US estate duty amounts are much, much higher than ours. So all of that would need to be taken into account.
If the beneficiaries of an offshore investment are South African tax residents, would the money need to come back to South Africa, when they inherit? Or can they keep the money offshore? Do they need additional approvals to keep the money offshore? I think that's the question.
So if I'm understanding the question correctly, you're inheriting money offshore from a deceased estate. So no, you don't have to bring it back, but you do. It might have changed now with the change in legislation, but I think it was within 30 days you've got to report it to the Reserve Bank and ask permission to keep it there. Particularly applies to property that you might inherit somewhere else. You have to inform the Reserve Bank.
Okay, folks, I think we've reached the end of our time limit. We were promising to end at about 3:15, so I think some very interesting questions. But what became obvious in the question session is everybody's got their own individual circumstances, intentions, and questions. So hopefully we've given you a nice umbrella overview. We've got expertise, experience, and we've dealt with lots of different people in different territories. And if you'd like to get hold of us, or your financial advisor deals with us, very happy to sit down and share our expertise. But it's clearly a very complex field, and the number of attendees today certainly confirms the huge interest in this segment of the market. The presentation will be circulated. There is a 4th episode of a 4-part series coming on in 2 weeks' time in terms of financial immigration. We'll be sending this presentation and slides out. And the first 2, which talk about the actual assets that you invest in offshore, and some exciting offshore shares, are available on our website under local research if you go to videos. So thank you very much for your time. Thank you very much for your interest, and we hope to continue being able to add value to you. Cheers.